Broadcast is now starting. All attendees are in listen-only mode.
Good evening, everyone, and welcome to the February edition of Digging into the BI. My name is Kevin Galogli, and we're here to be able to talk about the latest stocks as they appear in the Better Investing, the member-only magazine. We have two featured stocks, Intuit and Walt Disney, and then we have two other presenters that are going to be talking about Addus HomeCare, and I'm going to butcher this, but Ignacio Eagle. Hopefully I came close to saying that right. And I notice I have the wrong date here. It should be February 9th and not February 6th. But we're glad you're here. Sorry we couldn't do it last week, but work interferes with this whole investing stuff, and that happens. Anyway, let's go to our next slide, Cheryl. And this is the standard disclaimer. We're doing these presentations for educational purposes. We believe, as Better Investing does, that you should conduct your own review and analysis before you purchase any company. We will talk about stocks. We may or may not own them. We will try to alert you to it. And if we show you stuff outside of stuff on Better Investing, it's not necessarily an endorsement or promotion of those particular products or websites or services. We will record it, and I promise you at some point I really are going to get them up on YouTube. At some point I really will get them up there. Anyway, next slide. So again, I see a lot of familiar faces, but in case you do not know who Better Investing is, we're an investment education organization that focuses on long-term fundamental investing. And if you see any of these blue underlines throughout any of the slides here, those are hyperlinks that if you grab the PDF, and we'll show you that in just a moment, you'll be able to gather it and to be able to look at where we're going with it. All of us that are doing these presentations are volunteers in the Mid-Atlantic region, and we're here just trying to share our experience of what we learned by becoming a Better Investor member. Next slide. Here's our YouTube page. We're creeping up, getting a little bit more up there. Again, we're trying to get up over about 300. We're hoping that when you see this stuff that you'll like and share it with the videos with others, and make sure to subscribe to the channel. Next slide. And here's, again, we don't really have too many people asking about the troubleshooting and stuff, but the real key thing is that third green, sort of olive green arrow down at the bottom, is that will show you how to be able to get the handouts. We have 4 completed SSGs in a PDF, as well as this slide deck. And again, you're welcome to share that and bring it with bring it to your club or to other people that are interested in investing like you and discuss it. That's the whole point of what we're trying to do here. Next slide, please. And so why are we doing this? Well, we want to be able to show you some of the things that you can get as a BI member. If you're not already a member, there's a hyperlink to a free 90-day trial for the magazine and the resources that we have here. We try to show people that may be uncertain of their judgment or just want to see what other people are doing with it, and to be able to sort of provide best practices. And I think one of the things I heard very early on when we were doing this is that people were saying that they really like seeing all the different ways that people sort of constructed their stock studies. We have a general form and an outline, but there's wide latitude to be able to select the things you think are important in discussing your stock, and you'll be able to see it 4 different ways tonight. We're also trying to be able to promote the 2 Mid-Atlantic chapters, a Maryland chapter and the DC Regional. DC Regional includes all of DC and all of Virginia, as well as Montgomery County, Maryland. And you don't have to be in the Mid-Atlantic to participate, although we do welcome those folks. And if you want to be able to know more about the Club Connect program, we'll talk about that as well. Next slide. So in just over an hour, we're going to go over 4 stocks. 2 of them are going to be featured out of the magazine. That's the stock to study and the undervalued feature, as well as 2 other ones that can come from a myriad of different spots. I think tonight we have another one coming from the ticker in a predetermined screen, and the other one was, I think it's a review of a presentation that they had done here previously. So it's just a way to sort of keep in touch with what we're doing. Next slide. So here's where you can find the information on the 2 featured stocks tonight, Intuit and Walt Disney. the Walt Disney Company. Again, these were announced on November 11th. And you can see all the stuff. I think they just put up April. So you can see 2 months in advance going forward. And I always think it's good that if you are a regular attendee, to go to this site, download this, a couple days in advance, and maybe even work on one of those two stocks that are featured so we can be able to have a lively discussion of what's going on. Next slide. Here's how you can get announcements of what's coming on up, not just from your local chapter, but from headquarters as well. If you go up to the red circle where it says My Account, that will open up the screen capture on the left center part where we have the red underline that says My Account. You can go to email product subscription information, that's a green circle. That will open up the screen capture on the right that's in green, and you can be able to sign up where it has the yellow highlight for the national news, the BI Weekly newsletter. But then before you leave, make sure to be able to click that one down there with the local chapter news to let your local chapter know what's going on. And then, of course, you're going to have to hit that save changes for everything to hit. So please do that. Next slide. So here's what the latest weekly newsletter goes. This is just for members only. Although you do not have to be a member to participate in this webinar, we're glad for even beginners to be able to come and take a look at it. But this shows you a lot of the things that are coming up, upcoming ticker talks, and also we have our national convention that's coming up at the end of April. Several of us will be participating in it. We hope to see you there, and if you are there, please come and say hello to us. We love to see other people that have been coming here, because doing stuff virtually, you sort of miss that one-on-one connection. But all of this stuff comes out in the weekly newsletter around the close of business on Thursday. So if you signed up for it and you don't see it, check your spam filter. Cheryl was starting to show us the next slide, which is our Facebook page. This is something that we have with both the chapters. I haven't been getting stuff up lately, but again, if you do have a club and you're in the area, go ahead and like us and tag us. And, that way we can be able to promote your club when people are looking around. Next slide. Brian, you want to tell us all the fun things that are going on in the Maryland chapter?
Well, we're starting to do our planning for this year. We just started the stock picker contest in January. It'll be going through August, and then the winners will be announced at the annual meeting. And that's where we are with the Maryland chapter.
Thank you. Cheryl, tell us what's coming up for the DC chapter.
Well, at the very end of this month, we're going to have SSG classes on two Saturdays, the 21st and the 28th. It's free, though we will accept donations. And we're going to be taking the first 25 people. I realize a lot more people signed up, and we will have more classes in the future to try to accommodate those people. But that is our biggie, and we will be talking more about the model clubs in a little bit, but that is the big event for this month.
And so I'm going to be talking about my club, the Montgomery County Model Investment Club. We meet on the third Wednesday of every month, so it'll be the 18th this month. It's an online, so there's our link for it. We have an education program that's investing in the middle of a dollar weakness, and then our stock study is D-Local. And there's a picture of not just our club, but several other clubs. What we do is we get together socially 4 times a year at a person's house in Silver Spring, and we like to invite other clubs to come along. It's a great way to be able to meet other people that are like-minded. We also bring a potluck, so if you like eating and socializing and talking stocks, come and join us. Like I said, we do it 4 times a year. I think our next one's coming up in, it's either March or April. I can't remember. One of those months. March. There we go. Thank you. Anyway, but that's how you can find out more about it. Next slide. Maskey, tell us about your.
I'm asking, member of the Model Investment Club of Northern Virginia. Our club has been in existence for more than 10 years, I would think. I've been a member at least 6 years or so. We meet on every Tuesday, the third Tuesday of the month, for 2 hours. And we also have a planning meeting just 1 week before the actual meeting itself to get ready for the meeting itself. And our educational presentation for this month is GAAP versus non-GAAP financial meeting. And then the stock presentation is, I can't pronounce that name, it's Odilgo, or so is the name of the company that one of the members will be presenting for this meeting. That's all I have about our club. If there's any other questions, please ask me. I'll be able to answer.
Thank you, Maskey. And let's go to our next one. And Brian, tell us all about Blue Point.
Well, we're in our 28th year and still doing fine. The only change that I have to that is I just sent out a meeting. We're going to start I'm calling it the Between Meeting Education and Discussions. It's going to be about a half an hour, and we're just going to go over some training and discussions that don't seem to fit into meetings, especially with since we're of upper level age, the macular degeneration thing, people don't like to drive at night. So we can sit at home and do this. So that'll be starting this Wednesday.
Very good. Sounds fun. Let's go to our next slide. And Cheryl, tell us about your club.
Happy Destiny. We have 7 partners, started in 2001. The Friday, third Friday of the month is when we meet. So the next one is February 20th. It's be from 6:30 p.m. to 9 p.m. It's online, and there's the link to join. Also, we are doing stock studies on D.R. Horton, the housing company, and education is yet to be decided. And also, I tell you about Club Connect. This is a program for BI members, clubs, and individual investors on that free 90-day membership program. And it's helping clubs that are looking for new members, as well as individuals that are looking to join a club. You fill out the form online. You can go here, you see investment clubs, just go down that listing there, and there's Club Connect, and look into it depending on which side of the equation you're on. It's proven to be very helpful.
Thank you. Well, this is called Digging into the BI, so we ought to at least take a look at the magazine. If you're a member, you get it as part of your membership. This one is a joint issue. The winter issue is combined. So this one came out in mid-December. You can get it electronically over on the left-hand side, or you can get an e-magazine from the website as well, or you can be like a lot of us, proud Luddites, and wait for the paper copy to come in your mailbox. But if you want to see it faster, it comes electronically that way. Let's go to our next slide. And this is how you can be able to sign up for that. If you go to the Learning Center over on the left-hand side, where they have the green arrow, the Better Investing Magazine for mobile devices, it's a different sign-in. You can take a look at it there. While you're over it, see that red arrow to the analyst reports and other resources. That's when you see these featured stories in our magazine, they always say that there's additional information on our website, and this is where you find it. Otherwise, you'll just sit there, and if you look at that screen capture right in the center that has the View Magazine issues, if you click on that, that will take you right to the magazine and the issue that you're looking for. So let's do that. Let's go to the next slide. And here's something that sort of stood out to me was this is James Skupik. He's with Provident Financial, but he's a certified charter financial analyst. And he's been doing this yield sign column for probably a little over a year or so. But I thought it was kind of interesting since a lot of us are looking for dividends. He goes, one of the things to keep in mind with those dividends is that, making sure that you have the growing earnings at a reasonable rate so that if the earnings are growing fat in excess of inflation, then you have less likelihood to lose the value or not have the dividends continue to rise and increase. So take a look at that. Next slide. Here are the things that are coming up across the country. A lot of them are free. A lot of them are online. This series at South Florida has been they're doing a deep dive into the real estate investment trust. Sophia has done quite a few things that are really quite interesting and informative. So that's actually going to be tomorrow at 7:30 Eastern. So consider signing up by going to the website and finding the URL to sign up for it. Next slide. Well, we've done enough about telling you what's going on. Let's start talking about some stocks. So we're first going to have Cheryl will talk about the stock to study, which is Intuit, and then Maskey's coming on board, and he's going to show us one he found from the A-list predefined screen Addus HomeCare. So let's go on, and Cheryl, tell us about your company.
All right. Let me get this screen here. I always have the menu in my way there. This is on Intuit, and for those people who are not familiar with Intuit, they have all your financial goals all in one place. They do tax, they do meetings and notes and all kinds of different things, all putting into AI, and you can look into that on your own. Okay, founded in 1983 by Scott Cook and Tom Prue to modernize personal finance. Intuit revolutionized accounting by shifting from paper-based methods to user-friendly software like Quicken in 1984 and QuickBooks in 1992. The company grew from a kitchen table startup into a global financial technology platform. In the 2000s, at its 2025 Investor Day, they streamlined long-term strategy from their 5 previous big bets down to 3 core big bets to accelerate transformation into an AI-driven expert platform. And the 3 refined big bets are Intuit shifting from a do-it-yourself software to a done-for-you model, accelerate the money benefits, and fuel success for mid-market businesses that have somewhere between 10 and 100 employees. AI assisted in year-over-year growth. You can see in 14, they went from 8% to 13 in fiscal year 19, and now in 2025, they had 16% revenue growth. So strong revenue growth and margin expansion. You can see their original guidance for revenue went from 12 to 13% prior, and then now in 2025, they actually have 16% increase in revenue. And for the different gaps, non-GAAP is 36%. I'm sorry, GAAP operating income is 36%. Non-GAAP was 18%. GAAP diluted earnings per share was 31% growth, and non-GAAP diluted earnings percent 19. Again, also strong performance continued in Q1 2026. Revenue up 18% again. GAAP operating income 97%. Non-GAAP 32%, GAAP diluted earnings per share 127%, and non-GAAP diluted earnings per share 34%. So what they looked at was examining the customer problems for both consumers and businesses. They looked at the different problems that both those consumer and their business customers were having, so that they know how to proceed ahead. And they've got some bold 2030 goals. They want to double the household savings rate and improve business success greater than 20 points versus the industry. They want to be best in class and most trusted company, and they want to accelerate their revenue growth to 20%. So here are the Intuit platform advantage for both the consumers and the small business and mid-market business. Consumers, they have 86 million customers, 70,000 tax and financial attributes per consumer, 15 plus LLMs available to developers, 105 billion tax refunds on their platform per year, and 11.4 trillion visibility into consumer debt. Now, on the business side, they have 10 million small and mid-market businesses, 60 billion machine learning predictions per day, 625,000 consumer financial attributes per small and medium-sized businesses, 2 trillion plus invoices managed on our platform per year, and 18 million total US workers paid annually through their QB payroll. Their strategy drives strong momentum. Here is some more statistics on the consumer side. They have increased 24% for TurboTax Live customers, 47% for TurboTax Live revenue, 41% of TurboTax revenue in TurboTax Live, and they have 15% plus consumer platform revenue. In their strong momentum for their small and mid-market businesses, 8% US QBO customers, 14% plus online ecosystem, and 37% online money platform revenue to 1.4 billion. And here's for the mid-market. They have a 23% plus growth in mid-market customers, plus 40% mid-market revenue growth, 27,000 Intuit Enterprise Suite average revenue per contract, and they have around 300% projected return on investment over 3 years. All right, they also, on their opportunity of a 347 billion total addressable market, and that includes 97 billion small business and 89 billion mid-market, both US and international. Customers are 142 billion, and that includes personal, business, professional tax, and consumer finance. And they have market growth opportunities. Right now, they have 10 million in customers, where the total addressable market is 49 million. Consumer is 86 million customers currently, with a TAM of 242 million. So a lot more to come.
5 minutes, Cheryl, 5 minutes.
All right, here's the value line. You can see their annual total return, somewhere between 12 and 24%. Their PE ratio has 23, and it's out 5 years to 32%. And you can see where sales and net profit margin are growing. Here's Morningstar and CFRA. Morningstar has a wide moat and exemplary capital allocation, 4 stars. CFRA is a 4-star buy with 3-year projected earnings per share of 18%. Looked at it with core for the SSG. Intuit peers all have different focuses, where Intuit has many focuses all in one place, as we saw on that front screen. So it's really difficult to do an actual apples to apples. But you can see up straight, parallel. Also on the earnings per share, you can see that the black line, which is Intuit, pretty much up straight parallel, where the other lines are kind of going, shall we call it a roller coaster? The stock price, their stock fell sharply in early 2026 due to broad market concerns about AI disrupting software businesses, leading to lower valuation multiples, PE compression, despite solid fundamentals like revenue growth, strong cash flow, and AI investment. Intuit had strong growing financial results with significant expansion in operating margins and profitability, largely driven by a shift to the AI-driven platform. The company reported that for the full fiscal year 2023, its revenue grew by 13% and it achieved an increase in both net income and free cash flow. All management factors were higher in 2025 than the 5-year average. Here we see there's steady 10-year growth rate. I used 11.4% forecasted sales that resulted in a 5-year projected sales of 33.34 billion. Again, steady 10-year growth rate. Earnings per share forecasted 14.8%, results in a 5-year projected earnings per share of 29.17.
2 minutes, Cheryl, 2 minutes.
All right, thank you. PEs are returning to earlier lower values found in fiscal years 16 through 20. So I set the average high PE forecast at 30, which gave me a high stock price forecast of 875.1. Same thing for the low. I set the low forecast at $22. This gives, and then lowered, increased rather. No, I'm sorry, used the 80% of current price for 347.3 for the low stock forecast. Based on projected high and low prices, the current price is well within the green buy zone. And again, you can see that the upside downside is 5.1 to 1 with the current price well within that buy zone. The compound total return using the forecasted high PE gave me a potential annualized price appreciation of 15.1%, a yield of 1.1, and an annual rate of return of 16.2, with the current yield being 1 and the payout forecast being 34.1. In conclusion, Intuit is a medium-sized company with Morningstar financial health grade of B, which is above average. Intuit's a well-managed company. It's currently undervalued, trading well below its 5-year average of 30.3. I'm sorry, the current PE of 30.3 with the 5-year average high of 49.3. Intuit is a buy up to 479.3 with a buy price of 457.20 to satisfy 3.1 to 1 upside downside and a 15% total return, and the current price of 443.77. It's a worthy candidate for your research consideration. And that is my report.
Thank you, Cheryl. And next, we're going to hear from Maskey, and he's going to tell us all about Addus. So take it away, Maskey.
Oh, yes, Kevin. Addus is a healthcare service company on personal care, hospice, and home health. Next slide, please. The company is the leading provider of home-based care with cost-effective position and it has a well-experienced management team. Next slide. Addus is primarily based on home health care, personal care, and hospice. It is present in 23 different states with 283 locations and approximately 50,000 employees. Next slide. Addus provides cost-effective care services across all three segments with net revenues of about $1.4 billion. Personal care represents 76.5%, hospice is 18.4%, and home health is 5.1%. The largest portion of these funds comes from local, state, and federal government payments. Next slide. Company's model is based on managed care organizations that have the responsibility for services for both home and community-based. Addus is focused on providing both clinical and non-clinical services at home. Next slide. Addus has a diversification of payer mix as seen on the graph of managed care organizations, Medicare, federal, state, and local agencies. For example, the Illinois Department on Aging covers a large segment, 18% of the mix. Next slide. The gross margins have stayed around 31% for the last 5 years, starting from 21 through 24. And the same with the EBITDA margins, around 12% for the same period. Next slide. Following key growth drivers gives Addus a competitive edge in a market consisting of 18,000 licensed home care service agencies. 35% of lower cost care is compared to traditional care settings. It has a market with ample white space, 15%, supportive legislative trend in key states, and aging population in US. Next slide. Addus has developed the following strategies through organic and acquisition to drive strong growth. Next slide. The industry trends. Aging population. US senior population 65 plus is expected to grow from 58 million in 2022 to 82 million by 2050, with 90% preferring to age in place. Cost efficiency. Home care is 30 to 38% cheaper than traditional care settings, driving demand. The market opportunity is highly fragmented market with only 15% captured by the largest providers, offering significant consolidation potential. The legislative effort, favorable medical trends in key states. Next slide. The growth strategies. Organic growth focuses on existing and adjacent markets, leveraging industry trends, referral sources, and payer alignment. Acquisitions. Pursue accretive acquisitions in favorable market with strategic alignment to expand scale and coverage. Value-based care. Leverage care multi-segment offerings to negotiate favorable rates with managed Medicaid and Medicare Advantage plans. Next slide. The compounded annual growth rate for the net service revenues is 10.2%. for the past 3 years from 2022 to 2024, and the quarter is 25%. The compounded annual growth rate for EBITDA is 17.2% for the same period, and for the quarter it is 32.6%. Next slide. The compounded annual growth rate for the net income per diluted per share is 22% for 3 years from 2022 to 2024, and for the third quarter between 2024 and 25 is 12.7%. The compounded annual growth rate for adjusted net income for per diluted share is 18.8% for 3 years from 2022 to 2024, and for the third quarter between 2024 and 25 is 20%. Next slide. The SSG Plus shows all three sales, earnings per share, and pre-tax profit is up in parallel. The sales are up by about 25%, and the earnings per share are up by 12.7% for the third quarter ending in 2025. Looking at evaluating management, all three of them, the pre-tax profit as a percentage of sales, return on equity, and debt to capital all look green. Next slide. Addus is growing steadily for the past 10 years with 15.4%. Next slide.
5 minutes, Maskey. 5 minutes.
Okay, thank you. Addus EPS has a steady and consistent growth rate for the past 10 years compared to its competitors, which has ups and downs. Next slide. Sales are steady, consistent with APS that follows along with acquisitions to support the growth of the company. Next slide. Here, Addus, the black line, is consistent and has a steady growth compared to the others, which has kind of zigzag lines, you know, I call it zigzag. Next slide. I used a 10% growth rate for sales and earnings below for the 2-year, from the 2-year analyst forecast to come out with a 5-year projected sales of $2.3 million. The analysts are expecting a little more than that, like 14 and 15%, but I just put down 10% for both sales as well as the earnings per share. Addus's historical sales compared to its peers were good compared to the other companies, which were smaller companies, and also the order growth were not consistent throughout the last 10 years. Next slide. Here again, I use 10% growth rate for the earnings per share, much below than the analyst estimate of 15% growth, as you know, as above you see it. Next slide. I used a 5-year average PE of 34, and then the earnings per forecast of $7.72 to come out with a high price of $255. Next slide. I used a 5-year average low PE of 22.3 with a low EPS forecast of $4.67 to come out with a low price of $104. But I used the low price of $86, approximately 80% of the low price of 106.9 price, you know, as of 2/3/26, February 3rd, 26. The current price of the next slide. Current price of 106.9 is halfway between the buy range of $86 and $128.4. Next slide. In this potential gain versus loss chart, the upside downside ratio is 7.1 at the current price of 106.9 as of February 3rd. Next slide. Addus is undervalued. Its 5-year average PE is 28.1, and the current PE is 22.1, consistent with sales and earnings for growth over the past 10 years. Addus is a well-managed national company present in 23 different states. And its buy price to satisfy the upside downside ratio of 3-to-1 and 15% total return is $127.1. The current price is $106.91 and is a buy up to $128. Addus is a worthy company for long-term investors and can be added after further study or to your watch list. That is my presentation for Addus.
Thank you very much, Maskey. Appreciate it.
Thank you.
Okay,
Thank you.
next we're going to have 2 more presentations. These will be in plus. And Brian Koenig is going to be talking about Ignacio Eagle Mines. And then I'm going to be talking about the undervalued featured, which is Walt Disney Company. So, Brian.
Okay, good evening. Brian Koenig. I'm a Maryland chapter volunteer. Been here before. Currently on the Bible board as a secretary. Tonight my pronunciation is Agnico Eagle Mines. And it's an update from 2026. Next slide. Founded in 1957, it's been creating shareholder value since then. A senior Canadian gold mining company. We'll see that it has operations in around the world, and we'll talk a little bit more about that. It's a pipeline of high quality gold products. Agnico Mine demonstrates a characteristic of a high quality company through historic performance, improving financial efficiency. Consistent growth is supported by a significant upward trend in profitability. Company's return on equity is stabilized. It's 9.3, and which is a little bit above the 5-year average of 8.4, indicates effective management. We'll see some more about that. Shareholder capital, following more volatile periods in previous years, has shown exceptional fiscal discipline by reducing its debt to capital ratio from a peak of 27.5 in 2018 down to 5.8% in 2024. And what that equates is that went from $2 billion down to about 340 million in a little over just a few years. So it's a very well managed company. It's currently the largest gold producer in Canada. It solidified that position with a recent merger with Kirtland Lake Gold. It generates profitability, a portfolio of high quality mines in mining friendly jurisdictions. Next slide. They focus on producing stability and low political risk. It realizes secondary revenue from byproducts such as silver, zinc, copper, and in addition to the gold extraction process. Next slide. And here we can see Australia, Finland, and a few down in Mexico, and then the rest in Canada. Next slide. And there's some more the businesses for the southern business, northern business, and then the exploration where they're doing that. Next slide. Okay, we'll get into some numbers here. The closing price last Friday was $196. The 52-week high price was $225.92. The 5-year sales growth, the preferred procedure, if you look at the preferred procedure box, you will see over on the right-hand side that there are 6 boxes. I got the 28% from the sales growth box. Right below it, I got the 5-year earnings per share growth of 14.7 from the earnings per share growth box. And then what I did, I put my numbers in, and the earnings per share growth that I got out that I'm going to use for my calculations that came to 24.6. The only changes that I made was the taxes stayed at 32.8%, but I did increase the shares from 503 million to 510 million. It seems that they're sending some shares out. And then that results in a 5-year earnings per share of 11.35. Next slide. So here we have the graphical representation of it. And it said there that 25% was from the preferred procedure slide, and then the 24.6 was the result of the preferred procedures. Next slide. And then just to show that where I was fit on the scale here with the member sentiment, sales, you can see the numbers there, 18.9, earnings per share 13.8, total return about 15. So you can see that mine are a little bit less conservative than the member sentiment. Next slide. That was 73 studies in the past 90 days that they gave us that data. So here to evaluate management, you can see that it, if you take 2018 out of there, it's steady and increasing. So that's good. The next slide. The return on equity, again, it went from 9.3 up to about 9.8. And again, take 2018 out there, it's steady and increasing a little bit, so that is good. Next slide. And this is the impressive part of it that I mentioned. In 2023, the total debt was $2 billion, and it dropped it down to where almost probably in 2025, the next quarterly or annual report comes out, it's probably going to be well below the 340 million. And the debt to capital has been decreasing since 2018. So management is doing an excellent job. Next slide. So here we look at the valuation and return, section 3. We will note here that we'll talk a little bit more about the numbers, but for the dividend, if you look in column F, they kind of have the dividend at $1.60, and it's remained that way. The payout was in about the 40% range the last couple of years, but with the increase from $3.78 for earnings in column C down to the current of $6.85, I think that we're going to look at the high yield going from 3.6%, maybe down closer to 2% unless they increase the dividend. The other thing I'd like you to notice is down on the bottom right there, the current PE ratio of 28.7. We'll be using that again. Next slide. Okay, here in part A, using the high PE with the current 28.8, the 1135, the front side connector, and you get a high price of 326.9. I took 80% of the current price, 292, I think it was. Got 158, and so that gave me a ratio of 3.4 to 1, and it's right in the buy range. But I think the price today may be tickling out of that. We'll talk about that. But if it goes from 196 up to 326, 327, that'll be a 66% appreciation. So that's not too bad. Next slide. Here it shows
5 minutes.
Okay. Here again, the upside downside ratio 3.4 to 1. You can see the numbers where it fits in there. And today it went up $13.24, so it's 209.84. So it's just into the hold zone with today's price. And the bottom, the 158, was where I got 80% of the current price. Next slide. So the 5-year potential, if we look at that, we find out that the total PE, or the total return, is going to be 12.8%, a little bit under the 15 we like, but 12.8 is not too bad. It's 10.7 with the annual price appreciation, 2.1 for the average yield, which gives us a 12.8. And if it ever takes a dip down to 170, 178, we'll get the 3-to-1 and a 15%. Next slide. We look here, it just talks a little bit about the proven execution of the company, what it's done. I'd like you to see the shareholder focus down on the bottom. It's an A3 rated balance sheet with dividends and buybacks. Next slide. And to bring it up to date, it's on the 8th, it was announced that it will release its fourth quarter annual report here in a couple of days. Just for those of you who are thinking, don't understand it, the quarterly reports are required by the SEC 45 days after the end of the quarter. The annual ones, which is what this is going to be, are 60 to 75 days. So they're going to be coming in a little bit ahead of that. But that's just it. And one more that I got today about the precious metals, that even though they went down, excuse me, 10% and 30% for silver, the downturn was fueled by unwinding trades and margin calls and not a decline in the fundamentals of the company. With prices recovering, many investors should find value in buying the dip. And the Agnico Eagle Mines should be seeing strong growth ahead. Next slide. So there we have it, medium-sized company. It's in the buy range or just out of it. And those are the numbers that we talked about for a medium-sized company and the basic materials. If that fits your portfolio, it might be a time to buy it, depending on what you believe that the gold is going to do. But the company is a good, solid company. So I shouldn't have any problems with that. Now, real quick before we go to the next one and end it, I did this report back when it merged with the other company with Kirtland Lake back in October of 2022. The initial price was $42.23. If for today's price, it's gone up 93%. In July of 2023, we did an update on it from $52.09 to today's price. It's 88.7%. So the company did well. If I would have bought it back in 2022, I'd probably be smiling, but that's not the way life goes. Okay, next slide. Over to you, Kevin.
Thank you very much, Brian. Appreciate it. Boy, you guys all did your presentation so fast, so this means extra time for me, right, Kent? No. Anyway, I'm here to be able to talk about the Walt Disney Company, which is the undervalued feature, and it's also one of the more widely held stocks in the better investing community, being at number 12 on our annual list of the top 100. So let's go to the next slide. And I always like to sort of look at the article to see what was their rationale for why they did it. So as it says here, the members of the editorial and advisory security review committee suggested that as spending winds down, that these margins and their earnings are going to increase and they'll get this real nice boost from it. So they've gone through a lot of expenditures and purchase of stuff, and that they are, as they also saying, they're going to be spending $60 billion over the next decade on capital expenditures, and then also spending another $30 billion with management announcing into their domestic theme parks. So kind of interesting. Let's go to the next slide. And we look at this and you're like, oh, why are we looking at this one again? I mean, you can clearly outline and say, yes, you can see the impact of having theme parks closed in 2020 and also slow in coming back in 2021. They ended up getting a new CEO in like 18 or 19, and he was gone by 21, 22. So they didn't like what was going on. The one thing to keep in mind with these undervalued features is that they're supposed to go up. The goal is to go up 15% over the next 18. Actually, I think it's supposed to be 20%. I said 15. It should be going up 20% over the next 18 months. And it really only has to go up $15 to $18 to be able to achieve that. So that may not be too out of the realm of possibility. But again, if you look at this, you're like, yeah, that's a really kind of tough one to take a look at. Let's go to the next slide. This is what's generally considered a turnaround company. It's been down, it's been beaten down, and when you have one of these, and I've done this slide now like 3 or 4 months in a row because I've been the fortunate one that's been getting these undervalued features, and a lot of them have been real turnarounds. Is that you have to wonder, do these companies have enough financial strength or health to make it out of the downturn? And does management know what the problem is, and are they going to fix it? And so you want to be able to listen for things like, okay, what's their plan for coming back out of this? Do they have enough money and financial wherewithal to do it? And what's going to be that catalyst that will end up changing it? Otherwise, you may end up being sort of like that image over on the right-hand side, that Sergeant Farrell from um, one of the Tom Cruise movies. I forget now. It just disappeared from my brain. But the thing is that if you were a newcomer to better investing, I probably wouldn't necessarily recommend looking at this particular stock. But if you have a little bit more experience and you sort of can read some of the nuances that go on with that, this is something that perhaps maybe to take a look at. And that's what we're going to do today. So let's do the next slide. Here's sort of a broad overview. I actually took this from Helen Albanese, who presented it, I think, in August of last year. It was the stock to study in August, and now it's the undervalued feature. Is that there's 3 segments really to Disney. There's entertainment, experience, and sports. And sports is ESPN, but they've also ESPN just made a deal to acquire the NFL network, and the NFL gets 10% of ESPN. So it's something to keep in mind. The revenues by segment, it's 45% by entertainment. That's all the streaming and the movie studios and the like. The experiences are going to be the theme parks and the cruise lines and stuff like that. And it's that they only are 38% of the total revenue, but they're 60% of the profits. So it's something to be able to keep in mind. And the new CEO came out of the experiences part. So keep that in mind. Let's go to the next slide. So Disney's been on a real buying spree. In fact, the outgoing CEO, Bob Iger, who's been there since '02, left in 18 or 19 and was brought back in like 21 or 22, and is leaving real shortly, is that he ended up making a whole series of purchases of stuff. A lot of them in the entertainment field. This is a Motley Fool story about it. They talked about 10 major acquisitions that they made over the last 20 years. I mean, things like Hulu, they now have 100% ownership of it. Um, the Fox Entertainment stuff is in there. Some of these streaming technology platforms, you can see that they've been really going on these huge buying sprees. Fox Entertainment in particular, I think it was a total of like $70 billion. They took on $20 billion in debt, but they get a whole new basket of stuff and the like. So there's a lot to see, that they realize that traditional TV and pay, cable TV is not the way people are going. So they've been sort of adjusting things for that, as well as doing their cruise lines and their theme parks. So let's go to the next slide. So the question is, okay, will Disney recover? Well, again, they have a new CEO, Josh D'Amaro, who's coming in March of 2026. He's already heading up the Disney Entertainment, the one that has all the big profits. But just to keep in mind, the previous person that they took when Iger first tried to leave also came from entertainment. So, it doesn't necessarily mean that that's the right thing, but they are generally pretty positive, as you would expect them to do. But again, some of their plans are, and this was just a straight search, benefits of AI and in just search engines, is how they're going to be able to continue to sort of reposition themselves with streaming and media. They want to be able to do a lot more with their parks and experiences. They're going to try to do some things on the cost side, and they believe that they're going to have one of the things that they really do, they call it content strategy, is Disney, better than anyone else, has been able to monetize their intellectual property. Look at how, with Avatar or the Marvel characters. They also are now talking, since they have Fox, they have The Simpsons, and how they may be able to roll out a whole new series of things there. So that's sort of one of the things that they think are going to be part of their recovery. And that's the way to sort of look at this. Let's go to our next slide. Their total addressable market is huge. I mean, it's kind of hard to find a real competitor because they compete on the entertainment side with like Warner Brothers Discovery as well as with Comcast on that. And then they're also a movie studio. They also are a parks and entertainment, and then they're a cruise line. So they have all of these things going on in here, and the like. They've been building out their streaming, their direct to consumers stuff, and we expect to see even more going on with that. I'll talk about that a little bit more. But overall, they have this huge global reach that no one else has. Let's go to our next slide.
5 minutes, Kevin.
Thank you.
5 minutes.
So in the streaming field, the big player is as Netflix, and they have all the original content. Right behind them is Amazon Prime Video, and then sort of in that next mid tier, you have like YouTube and Max and HBO Discovery, as well as Disney. So seeing how they can be able to grow that would be certainly a real interesting to see if that's sort of a method in terms of how they're going to use their product lines that they got from Fox, as well as all the stuff that they have, and do that going forward. Next slide. The person who Josh beat out for being the CEO was this woman, Dana Waldron, who came over with Fox when it was acquired and stuff. But they kept her on, and they're going to make her. They're creating this chief creative officer. Now, sometimes a person who loses, that may not necessarily work. The news, of course, is kind of positive. You would expect that to be sort of the general thing. But a lot of entertainment in studios have been doing this, where they sort of divide the business section from the creative section. In fact, a lot of them harken back to what Walt Disney did with his own brother, Roy, that one was a creative and one was business. Roy was a business guy. And so they think that this may be a way to go. We'll see if, again, maybe it's all sunshine and puppy dogs. Maybe it's all a mask and stuff like that. But she does have a wide range of experience in the entertainment field. They've made all these major acquisitions. This would be a key thing to be able to see if they can start moving all those streaming and the entertainment stuff going forward. Next slide. Manifest gives it decent numbers, but not spectacular. Nothing that you want to go, woohoo. I mean, they have a sales growth of 5.5, and they have a PAR, which is a projected average return of about 11%, and the like. Yeah, it's not too bad, and the like. Let's go forward. So I like to also look at some of these secondary metrics because, again, if you look at that red one, that's their total debt. And look at from when they made the acquisition of Fox, they were at 61. What's that? It's huge, 61 billion in debt. And just in 5 years, even during the pandemic, they've gotten that down to about $45 billion. That's huge going forward. The light blue one up there is the shares from the top of where they are. They're planning to be able to buy back more and more shares, and then the purple one there is the free cash flow, and you can see where they've made major acquisitions or they had a downturn in the theme parks. They also stopped their dividend for a little bit of time so that they could sort of build up their resources. So just to take a look at it. Next slide.
2 minutes, Kevin. 2 minutes.
Thank you. So I went with a 6% sales growth and stuff. Even though historically this earnings growth is a negative, I mean, you have to really take out those down terms. I think 9% is not too unreasonable when you consider where their growth is in entertainment and in the experience, to be able to take that forward. And that's sort of what I came up with by doing sort of it's not quite a preferred procedure, by looking at some of the scenarios that can happen with margin and taxes and buybacks. Next slide. Section 2 looks pretty good, not spectacular. The financial health grade, I always look at that. A B is really, that's above average. So again, when we're talking about a turnaround, that's something I would always look to be able to see. It's sort of a quick measure on sort of how they are on the balance sheet. Next slide. Here's the section 3. You can see I took out the years on the pandemic because those are just crazy high numbers. You can also look at 10 years rather than 5 years, and you can be able to see that. Again, they didn't pay dividends for 3 years. They just started instituting it in 2024. I think those are kind of reasonable numbers. Look at the PE right now at 15.8. And if you look at the 10-year or 5-year average, or even really the current trailing 12 months, 18 to basically 12, this puts it slightly on, right about fairly valued. Next slide. Section 4, you can see my numbers in terms of where I went. I went with a 24 for a high PE, a 16 for the low PE. I decided to trim that from what the historic numbers were. I get a 5-to-1 upside downside ratio with a potential price appreciation of 134%, where we try to get 100%. Next slide. And here again, they're instituting a dividend. I took that payout ratio, sort of a projection that's out of value line, to be able to take a look on where they think they are. And here we are. We're getting a 5-to-1 with a 19, almost 20% total return, 15 or 16% on the projected average return, higher than what we saw in Manifest. I think it's a buy up to 121, and it's selling at 107 as of close of business today. Next slide. So it's a super large, slow growth company. This is not the undiscovered gem. The future growths are maybe a little bit optimistic. Some of you may say way too optimistic. The visual analysis is unappealing. But again, if you understand what was going on in the global pandemic, you can see the rationale. It's a beaten down stock with a good turnaround play. It's undervalued when you look at the historic PEs. Maybe it's fairly valued if you're looking at sort of current revised ones. I think it's a buy up to 121. Maybe it's not necessarily a long-term holding, which is, again, undervalued features are generally looking to go out just a couple of years. It may be something where you can be able to move in and make a little bit of money off of it. Next slide. So that was sort of my conclusion. And here's all of our presentations. We did Intuit, the Walt Disney Company, Addus, and I'm just gonna call it Eagle Minds. And let's go to the next slide. And this is what we'd like to do. We'd like to use T. Rowe Price's life cycle, because all companies sort of have a growth, maturity, and decadence to them. And we want to ask all of our presenters why they pick these particular locations for their stocks. And we'll start with you, Cheryl. Why did you pick that spot for Intuit?
Well, Intuit's been around a while. I don't think I can call it an explosive growth young company. But they are going heavily into AI, and they're covering the gamut in terms of financial reporting. Whereas I said before, their peers are, maybe doing one, maybe two of those areas. They're kind of the full package. So I put them just starting the mature growth. But things can change as they add more AI.
Maskey, tell us why you picked that location for Addus.
It is a growth company, but it is somewhat in the lower stages of the growth. And I think I would foresee more growth coming up. And right now, I think probably that may be the place where it should be. But we can expect in the long term, the growth is there for this particular company.
Okay. Brian, why did you pick that location for AEM?
Well, over time, it kind of moves on up toward the mature growth. And then if a opportunity comes to purchase a good mine in a good location, they will take that. I think that a lot of the growth right now has to do with just the price of gold, but that all fits into the mining world. So that's right about in, I think where it should be. It's not quite the mature growth part of it. It's a good growth company.
Okay. And Disney, yeah, I have it towards the end of mature growth. Again, it doesn't have a great visual analysis, but remember, it's in the consumer sensitive or cyclical area. And again, when you have a global pandemic, the middle of your visual analysis is going to look horrendous. And cyclical companies will do that. And you have to sort of look at the peaks and sort of measure through them. And I think you can see that there is some potential if you think that this management team is in place and if you like the plan that they're doing. I think it's there, but it's not clearly anywhere near an explosive growth. Some people may even say it's at the end of mature growth. It may even be towards the end of this, and it may not necessarily be the full investment opportunity, but I think there is some good opportunities with this going forward. Let's go to our next slide. So we've been doing all our chatting for a long, long time. Now it's time for you to be able to vote. We're not necessarily asking you to be able to pick the one that you want to buy or the one that had the best presentation. Which one sort of got to the point where you say, I want to do some more research on it? So Cheryl, if you can be able to release a poll, these are free. It doesn't cost anything to see what we're doing or to be able to participate in this. We love to be able to see what other people are thinking of all of this. We've got a pretty good three-way race going on here. I won't tell you which one is not making it. We got about 75% of you already voting. That's good. Can we get up over 80? We're at 80. I'm going to push it. Can we get to? We have a close race. So your vote can be able to put one up over the top. Which one is it? We have any more votes? It's holding. It's holding. Cheryl, I think you better release it and let everyone see. And there you go. Intuit. Cheryl, congratulations. But Addus and Ignacio, we're giving it a good run. And no matter how much I tried to convince you of Disney, you guys weren't buying it. That's okay. I understand. Anyway, with that, let's see. Kent, do we have any questions? First of all, Kent, are you still with us? You said you had to race off for other things.
Yes, I'm still with you, and the answer is we have a question regarding Intuit. So, yeah, Shelley, you want to take a look at that question up there? Basically, the summary, quick summary, is that.
Let me hide the poll first, and then I can look. That's the problem with running this whole thing is you can't just go from one thing to another.
Let me give a summary for the folks in the audience, and the summary is that the questioner Christopher asks, what's the likelihood of Intuit and their software being displaced by native AI software? If you want to upload your W-2 and all of the documents, would AI be able to basically push Intuit aside? That's kind of the way that I'm interpreting that.
Now I know and they talked about this in the Bears and the Bulls, that there was a chance of the government putting in free software, and that would be a problem for Intuit. But as far as people just being able to do something online, it would still require a program. The question is who controls the program with the taxes, and is that kind of what they were asking, or would they like to come on live and ask for more details on that?
Christopher, if you would like, you're more than welcome to come on in and
I
chat.
unmuted you, Christopher, so you're muted on your end. So go ahead and hit your microphone. And if you want to,
there you go. Now he's
there we go.
Self-muted.
Hey, good evening. Yeah, so that was basically my gist, but more towards the end of my question. You know, in general, when I think about disruption in AI, is who owns the data. And so you've got these massive companies, say like Salesforce and ServiceNow, et cetera, and they own that data, right? So I find that very that proposition of displacing them much more difficult, because AI is only as good as the data itself. But
right.
in Intuit's case, they don't own the data. You provide, the user or the taxpayer provides that data. And so I feel this seems a much, much easier proposition for an AI native solution to come in and take that business.
Well, I mean, as a user of a tax program, I wouldn't want anybody to own the data. I would want to have control over it, but I see what you're saying, that AI, as it increases in knowledge and capability, may be able to do something like that. But Intuit is also very heavily into promoting their own internal AI. And so it would be kind of the battle of the AIs. I mean, I don't know how else to kind of look at that. You're always going to have upstarts, and there are other companies that are trying to come in and do it a little bit cheaper and better and that kind of thing. So there's always going to be, threats from other companies trying to come in and take over that piece of it. But the thing is that Intuit also does a lot more than just the tax programs. And so, who knows, if things get dicey in one area, they could always increase their abilities in the other areas that they're already in. Whereas competitors, as I said, would have to really play catch up in order to compete with all the different areas that Intuit is using right now.
I appreciate your reply.
Thanks for participating. Anyone
Thank
else?
you for your question. That was a great question.
Yeah, very good question. That's the only question. That's the only question we have out there at this point. Does anybody else have any questions they'd like to ask any of the panelists at this point before we continue on?
Raise your hand. We want participation. So we have a lot of people from across.
Challenge the presenters here, folks.
Or as we also call it, stump the dummies. Anyway, let's keep going.
Kevin.
Let's keep going. But again, if people have questions, go ahead and raise your hand or type something in. We can always stop and go through it. But Cheryl, let's keep moving.
All righty.
So there's a picture of many of us that have presented. We were at the last in-person BINC there. We didn't get everybody. We missed you, Kent. Sorry, you were out there, being the mayor of BINC. I understand that, but the rest of us were there. Many of us will be there in April in Chicago. So please join us there. Also, if you need any additional information, you can either reach us at the Maryland chapter. There's an email, the DC chapter, as well as an email that's dedicated directly for digging into the BI. So please let us know. We're always eager to have other people participate and share your knowledge that goes forward with it. Next slide. You can join our mailing list. You don't have to be a member of the DC chapter. You don't even have to be a member of Better Investing. You can sign up. The URL is up there in the top in the blue to be able to do that. We don't inundate you. We're just usually telling you of educational things as well as this webinar. So please sign up, share it with friends. It's free. Next slide. Kent, tell us all about why you'd want to volunteer.
All righty. So one of the best things that I find about volunteering is getting to meet new folks who enjoy talking about investing, but also I get to learn brand new skills that I have not had before, or I get to improve the ones that I've got. And I also find it very rewarding in helping educate others and then providing a needed service, especially when folks have questions about finances and investing and whatnot. So that's been very helpful. However, as a more remunerative aspect to this, you can get discounted rates for attending the national training programs. In other words, attending Better Investing National Conference if you are a volunteer, and you can get complimentary subscriptions to the better investing tools, as well as access to other education and learning more about what folks are doing within better investing. So those are some really ideas or some benefits that I find very, very helpful. So that's it. Next slide, please.
So before we go to the next slide, I did see there was a comment here from Steve Emmerich that was telling us about Golden West. Steve, I've unmuted you, so go ahead and unmute yourself and tell us what you saw there, and get a chance to also tell us about your Heart of Illinois Breakfast Club. So do two at once. Go ahead, Steve.
Well, thank you, Kevin. We're excited. We do something every Wednesday morning. It may not be right, but we reach out to a lot of folks and have a good crowds. But the Golden West chapter does this monthly thing where they take a deep dive into a company, and this month they happen to be doing Intuit. We went over the SSG, kind of a deep look into the SSG this past week, Friday night. And this weekend, Bakul, or Friday night, Bakul Lala will be taking us on a deeper dive, and I think Bakul is in on the call, so you might pull him into this as well.
I don't see him. He sometimes shows up, but he's not here tonight. But also, so tell us a little bit more about your Wednesday morning breakfast club. Tell us how they can learn more about it.
Well, I'm with the Heart of Illinois chapter. I am the president, actually. And so if you just visit the Heart of Illinois chapter website, you'll see the link to it. It'll be under events, and we meet weekly. If you have any difficulties, certainly they can contact me through the chapter webpage, and we just have a good time. We have people from across the country. Mark Robertson is a kind of a frequent visitor. He's been not so much frequent because of his ongoing activities with Manifest, but we get Bakul Lala and Ty Hughes comes in. So we just get people from across the country. It's usually 24, 25 people.
What time? What are the times?
We share ideas and thoughts. Oh, I'm sorry. Thanks, Kevin. It's 8 a.m. Central. So you can leave your jammies on, but bring your coffee, your tea, and come join us.
Very good. Thank you very much, Steve. And hope to see you at Bink, too.
Appreciate it. Yeah, we'll do.
All right. Let's continue on now, Cheryl. So here's what we have coming up in March. I got to get stuff out of the way here. We've got, what's that? Adtalem Global Education. Could have butchered that one too. And then Trex is the undervalued feature. And I still have two undecideds. And that's the time for me to be able to say, hey, I am looking, this working and trying to do these webinars is for the birds sometimes. I enjoy my work. I picked up a new job and I really, really enjoy it, but it cuts into my time in terms of trying to find people to help put on these webinars. So if you're a regular attendee, we'd love to have you. We prefer to have people from Maryland, D.C., or Virginia, but we'll take you from anywhere. I mean, it doesn't really matter. It's the whole idea is that we're trying to be able to share the knowledge that we get through better investing and that we share with all the other people we know. So if any of those companies look good, if you have something you want to do, we're going to be back to the first Monday in March. Hopefully my work won't be kicking my butt so much anymore. It'll be 7 o'clock Eastern. We'd love to have you. Next slide. Here are the locations of some of the dashboards up on Manifest. I need to update some of them. We're behind on that, but I will get that done. I promise you at some point. But if we go to the next slide, you can see the hyperlinks for all of them. Again, another reason to be able to download the slide deck. You do not have to be a member of Manifest to see the public dashboards. They're set up that way. And again, you do not have to be a member of Better Investing to participate in this webinar. We're glad to be able to talk to newcomers as well as experienced folks. As long as you're interested in the long-term fundamental approach, we're interested in hearing from you. Next slide. That is really it. So one last look, Kent. Do we have any other questions? He may have left us. Anyway, there's our link to YouTube. Thank you very much for being here. We look forward to seeing you joining us on the first Monday in March. We had a nice turnout here, a lot of people from across the country. Thank you for being here. Please share and spread the word. And we are just trying to be able to show you how to become a better investor. Thank you very much. Have a wonderful evening. Good night.